And today I'm here to talk to you about the fundamentals of investing. So most people will come to a seminar like this on the basics of investing for a few reasons. So either they are dissatisfied with the returns that they're receiving and wondering if they can do better, or they feel as though they don't know enough about investments to make the right decisions. And possibly even they've left investing to someone else, like a spouse or a family member, and realize that they're not really happy about being in the dark. So for whatever reason that brought you here today, I'm just happy that you are here, because investing is an important life skill that can serve all of us in good stead, no matter what our age is and where we are in our life cycle. So today we're going to talk about a few different topics. Investing, as you know, can be complicated and overwhelming. So I'm here to help demystify that process so that we all can make more informed and confident decisions about investing in general. Today, we're going to cover a number of important topics. First, we'll focus on the four major asset classes, which are cash and cash alternatives, fixed income, equities, and alternative investments. We'll also talk about major investment vehicles such as mutual funds and ETFs. Next, we will cover the basic tenets of investing, including the benefits of compounding interest, the importance of staying invested, and how market timing can impact your portfolio. Then we will discuss the importance of asset allocation and portfolio diversification as a strategy to help you mitigate risk. And finally, we will quickly review all of the key topics and points that we covered today, and about how a financial advisor can help you formulate your investment strategy that's based on your unique goals. So let's go on ahead and get started. First of all, what is an asset class? Well, simply put, an asset class is a grouping of similar types of investments. And there are four major asset classes. We talked a little bit briefly about them: the cash or cash equivalents, fixed income, which are also known as bonds, equities, also known as stocks, and alternatives. The different asset classes behave differently in the markets and are associated with different levels of risk and expected return. And as a result, each asset class serves a different purpose in your portfolio. So let's talk about each one of them in a little bit more detail. Cash and cash equivalents provide liquidity within a portfolio. Cash equivalents are short-term debt obligations that can easily be converted into cash. Cash equivalents can include things like CDs, or perhaps money market accounts, or even US Treasury bills, which typically provide higher yields than a savings account. So while cash and cash equivalents have the highest relative degree of safety in terms of risk to your capital of all of the asset classes that we'll talk about today, their returns may not necessarily keep up with inflation over the long term. Fixed income, or bonds, is very similar to an IOU. When a bond is purchased, the buyer is essentially lending money to the issuer, which may be a company, it could be a government agency, a municipality, or perhaps even a financial institution. The issuer is expected to pay interest to the investor at regular intervals. It's usually semi-annually. And in addition to repaying the principal at the date of maturity, they will return that whole amount at the date of maturity. So maturity dates can range anywhere from 1 to 40 years out. And historically, bonds have been less risky than stocks, but with a lower return on investment. So therefore, bonds can serve a very major, an important function in your portfolio of providing a very steady flow of income for your portfolio. However, bonds tend to be more sensitive to interest rate fluctuations. And as interest rates rise, the value of the bonds tend to fall and vice versa. There are many different types of bonds, and the level of risk associated with the bond may depend on the issuer. So for example, US Treasuries are debt securities issued by the US government through the US Treasury Department. The full faith and credit of the US government guarantees the timely payment of principal and interest on these bonds. And the bond market views these securities as free of any sort of credit risk. Municipal bonds are issued by a state and local government, as well as their agencies, such as water and sewer authorities, or public power agencies. And these bonds may be backed by the general taxing power of the issuer, or can even be secured by the revenues for a specific project. So for example, when Governor Cuomo was building the new bridge, it was not an oddity that there would be some sort of bonds issued as a result of that effort. Another way to evaluate the bonds is to look at their credit quality. The credit quality is a measure of the issuer's ability to make those regular interest payments and to repay the entire principal at maturity. So issuers typically will hire a third party or another agency like Standard & Poor's, Moody's, or even Fitch to provide credit ratings on their bonds. The highest credit rating a bond can have is a AAA. And as you can see from this chart on the bottom right-hand corner, bond yields typically increase as the credit rating decreases. Equities or stocks these particular investments represent a share of ownership in a company. If you own a stock, the value of your shares may fluctuate over time because there's more risk associated with stocks. And historically, they have provided the most return of all of the asset classes that we'll talk about today. Over a short time period, stocks can be particularly risky, and typically they form the basis of growth in an investment portfolio through capital appreciation. There are three different categories of stocks, as you'll see on this slide. There are dividend or income stocks, there are value stocks, and then there are growth stocks. Dividend stocks are securities that pay regular dividends, often because the company is past the point of needing to reinvest the profits that they make. Most dividend stocks have lower levels of volatility than the overall stock market and offer higher than average dividend yields. Value stocks, as you see in the green in the middle there, value stocks are securities that have fallen out of favor in the market and are typically priced lower than the stocks of similar companies. The objective of investing in a value stock is to try to capitalize on the inefficiencies in the market price. Growth, as you see on the right in gold, are securities whose earnings are expected to grow at a higher than market rate. Often these companies will devote most of their current revenue towards further expansion, and as a result, growth stocks typically do not pay dividends, and they are selected for their potential capital gains. Alternative investments is just as the name implies. These are investments or assets that fall outside of the traditional markets. Real assets are tangible assets such as residential or commercial property, and these types of assets derive their value from their own intrinsic and inherent qualities. Absolute return assets are slightly different in that they seek to achieve a targeted return independent of any benchmark or any other standard. Equity hedge assets, as you see in gold in the middle, these assets seek to hedge the equity exposure of the portfolio and are usually negatively correlated with equities. And all that basically means is that they're generally going to generate positive returns in falling equity markets. Equity return assets are there in the silver or gray color on the screen towards the right, and these seek to return above average equity returns through more complex investment strategies. Then lastly, as you see in blue on the far right, private investments will include investments in private companies or investment vehicles that aim to provide higher than market returns through a longer term illiquid investment strategy. Investing in alternatives may offer qualified investors the opportunity to diversify their portfolios and to help reduce overall portfolio volatility. One of the most important parts of investing is selecting the appropriate asset classes for your goals. This slide here provides a summary of all of the 4 asset classes that we talked about and how they might be used in your investment portfolio. So for example, you might use cash and cash equivalents when you're looking to preserve capital in your portfolio, while the alternatives, which are on the far end of the spectrum, those might be used more for capital appreciation and diversification. So I want to take a moment now to talk about mutual funds and exchange traded funds or ETFs. A mutual fund is a portfolio of stocks, bonds, money market instruments, and other assets. Mutual funds are typically actively managed by professional money managers who are responsible for making the decisions on the security selections inside of that portfolio. And one of the benefits of investing in a mutual fund is the ability to invest across asset classes, which might otherwise be out of reach due to minimum account sizes or high costs. Exchange-traded funds, or ETFs, are investment vehicles that are designed to mimic the daily movement of a particular market index, like the S&P 500 or some other benchmark. And while mutual funds typically seek to outperform a benchmark, ETFs are slightly different in that they seek to provide the same performance as a benchmark. ETFs are typically passively managed and do not involve any particular security selection. So generally speaking, they have lower fees than mutual funds. But one of the benefits of investing in an ETF is the ability to gain market exposure at a lower cost and with more transparency than the comparable investment products. So having said all of that, however, ETFs may not offer the same level of potential dividend returns as owning those stocks directly. Next, let's talk a little bit about some of the basic principles of investing, including some common mistakes that investors make. One of the most important things to remember when it comes to investing is this: the earlier that you start investing, the more opportunity you will have in the long run for your investments to grow. So why is starting early so important? Well, it's very simple. The answer to that question is compounding. And as we all know, compounding occurs when the money that your investment earns is reinvested, which produces additional earnings, or what we like to call earnings on earnings. The effects of compounding can help a small, regular investment grow much larger because you have more money working for you over the year. So let's take a look at this example that we have on this slide here. Eric, as you see, is in the navy blue there. Eric invests $3,000 a year between the ages of 30 and 70 for a total of $123,000 invested. Assuming that Eric earns 8% per year, he will have a total of $842,343 at age 70. Jessica, who's in purple there, she waits until age 50 to start investing. And she invests $6,000 per year between the ages of 50 and 70 for a total of $126,000 invested. Assuming that she too earns 8% a year, she will have $302,537 at age 70, more than $500,000 less than Eric. So as this slide illustrates, time really can make a difference. And of course, a systematic plan of investing does not ensure that you will make a profit or even prevent a loss during a declining market. In fact, there's no guarantee that your account balance will increase over time. So when it comes to investing, even the most savvy investors will fall prey to bias and emotional trades. Movements in the market may make it uncomfortable, and movements in the market may also make you uncomfortable or emotional. But developing a plan and having the discipline to stay the course can help you avoid some common mistakes, such as buying and selling at the wrong time. Another common mistake that me and my colleagues see all the time is when investors try to time the market. Market timing can really be a costly strategy over the long run. Large swings up tend to coincide with large swings down, making it a very tough time to be in the market. The chart on the left demonstrates what happens to investors who simply miss the best days of market performance over the past 27 years. Investors who have stayed the course or stayed invested in the S&P 500 during this entire time frame earned an average annual return of 9.5%. But by missing the 15 best days of performance over the past 25-year time period, they earned only 5.8% in return. So by missing the 30 best days, their performance sank to just 3.4%. And often individual investors going it alone pull out of the market due to personal fears and emotional concerns about their money. And as a result, they miss the important days in the marketplace. So the chart on the right highlights that days that days with large price changes, whether those were up or down, tend to be clustered together. This chart here shows the growth of $100 in the S&P 500 from January of 1926 to February of 2019. And as you can see, over the long term, the S&P has grown despite economic downturns and geopolitical events. The overall trend has been upwards. So rather than letting emotions or psychology influence investment decisions, or even trying to time the market, it may be helpful to consider investing for the long term. This chart here shows the cumulative return on a $1 investment in the S&P 500, US small cap stocks, US long-term government bonds, and US 30-day Treasury bills against inflation from January of 1926 to February of 2019. During this period, the S&P 500 generated on average an annualized return of 10%, and that's compared to the 5.6% for government bonds and the 3.4% for Treasury bills. The take-home lesson here, or what this slide is illustrating, is that staying the course and keeping money invested in the market can result in significant returns over time, but may require a very long time frame in terms of an investment horizon. So ultimately, going it alone or going into this without a plan can be costly. The light blue bar on this chart shows the long-term return of the average investor in the 20-year period from 1996 to 2017. And as you can see, the average investor's long-term return is only 2.11%, below inflation. And again, we see that the stocks show the highest long-term return other than gold. So working with a financial advisor can help you stay focused on your long-term financial goals and take the emotion and the short-term movements in the market out of the equation. So this may help add value to your portfolio over time. So now let's talk about asset allocation and portfolio diversification. Asset allocation is the most important determinant of risk exposure and investment outcomes. Asset allocation is the process of combining different asset classes in your portfolio in varying proportions. And studies have shown that how you allocate your assets is the more important decision to make than what securities you actually will invest in. So establishing an effective asset allocation depends on understanding both risk and return. As we talked about earlier, every asset class has distinct characteristics and may perform differently in response to market changes. And as you can see from the chart on the bottom left, return generally correlates with volatility. So typically, the higher the potential return, the higher the potential return for an asset. The higher the potential risk, the higher the potential return for that asset class. And the lower the risk, the lower the potential return. So therefore, careful consideration should be given to determine which asset classes you should hold and how much you should allocate towards each one of those asset classes. So factors that greatly influence the asset allocation decisions are your financial needs and goals, the length of your investment time horizon, and your overall attitude towards risk in general. It's critical for you to consider these goals in any potential future events that come down the line when making your asset allocation decisions, and keeping in mind that the goals may change as you enter different stages of your life. If your priority is really preserving capital, then your portfolio may be weighted towards fixed income. But if your priority is growth, then your portfolio may be weighted towards equities. Diversification is another important concept. So what does it actually mean to have a diversified portfolio? Well, there are three main things I want you to consider. First, your portfolio should be spread among different asset classes and different investment vehicles. As we talked about earlier, each of the asset classes behave differently in the market, and the chart on this slide shows how investment vehicles from different asset classes correlate with each other. Asset correlation is a measure of how investments move in relation to one another and when. When one asset tends to move up, when another goes down, the two assets are considered to be negatively correlated, as shown by the numbers you see here in red on this chart. If the movement of one asset has no effect on the movement of another asset, then the two assets are considered to be uncorrelated. Investing in uncorrelated assets is really key to managing risk and return. The second thing I want you to consider when it comes to diversification is picking investment vehicles that vary in both risk and return. So picking different investments with different rates of risk and return can have a positive impact on your portfolio in the long run. Let's take a quick look at this chart here. The portfolio on the right includes only stocks and bonds, while the portfolio on the left includes a mix of stocks, different types of bonds, and alternative investments. This more diverse portfolio has the potential for not only lower risk, but higher return. The third thing I want you to consider is when you're considering diversifying your portfolio is diversifying your securities by industry and geography. There's a so-called lost decade, which is the period from 2000 to 2010. And in that time frame, or in that lost decade, it demonstrates the importance of global diversification and asset allocation. And as you can see, during that quote unquote lost decade, globally diversified indexes significantly outperformed the S&P 500. Having the right asset allocation will ensure a diversified portfolio, and this chart shows the best performing types of investments each year for the past 10 years. As you can see here, having a diversified portfolio helped to ensure the balance of return and risk. So I hope that this brief introduction for you has given you a better understanding of the fundamentals of investing, but let's review what those key takeaways are. There are 5 key things I want you to take away from today's discussion. First, different asset classes behave differently in the markets and are associated with different levels of expected investment return and risk. And as a result, each asset class serves a different purpose in your portfolio. Second, and perhaps most important here, is time is money. The earlier you start investing, the more time you have to take advantage of the power of compound interest. Third, staying focused and staying in the market may benefit you in the long term. So keeping money invested in the market can result in significant returns over time, but it may also require a longer time investment horizon. Fourth, asset allocation is the most important determinant of risk exposure and investment outcomes. And then lastly, diversifying your portfolio by asset class, by security, and by industry and geography can provide better returns and better risk and return opportunities for you. So I want to thank everyone for their time and attention today. It was truly a pleasure being here with you. As a financial advisor who's been in this business for more than 15 years, I've had the opportunity to help many individuals and families develop customized investment strategies that help them achieve their goals. I focus on helping my clients make the most informed decision and be confident in those decisions about their investments. And I'm happy to help anyone else here too. So before I let you go, I want to see, are there any sort of questions that you may have for me at this time?
Thank you, Tasha, for that. We have some questions in our chat box.
Okay.
And
okay.
So one of them is, under what conditions do you advise clients to invest in the stocks of an individual company?
When they're not comfortable investing in mutual funds or ETFs. However, every person's personal situation is going to be different. So really, that's kind of a loaded question in the sense that I would need a little more information about your overall investment objectives and portfolios in order to be able to tell you if it is the best time for you. But generally speaking, you can look to invest in the individual stocks of a company when you're not really looking for the diversification that comes from mutual funds or ETFs.
Okay, I have another question. For young college students, do you advise them to start investing even if it's a minimal amount?
Absolutely. If they can, the sooner the better. Even if it is small amounts, as we saw earlier, time is on your side when you're a young person, in that you have the whole time frame ahead of you, or your time horizon, to watch your money compound. So I would say yes, if you can, in some way, shape, or form, start investing on a systematic basis. Absolutely.
What would those investments look like for a young person?
Well, the young people today, they tend to like more stock picking. They tend to like things like Robinhood, getting on there and making their own trades. I personally feel that mutual funds and ETFs offer more diversification. I like to think of them as like a shopping cart, if you will. And inside that shopping cart, just like when we go grocery shopping, we put different types of things in there. We don't put a whole cart full of Apple Jacks or a whole cart full of milk, right? We actually choose different investments, just like we would different foods that go inside of our shopping cart. So mutual funds and ETFs are a way of diversifying or getting more bang for your buck, if you will, because you're able to invest in many more in instruments than you would be if you chose one stock in particular. So I would say mutual funds and ETFs are a good place to start.
I have another question. How does your firm evaluate a client's risk appetite and other behavioral factors?
Well, we do a very thorough job of discovery. There's a 4-step process that we typically go through. The first step of that process is discovery. Second would be to advise. Third would be to implement, and fourth would be to monitor. So how we identify what someone's risk is in that discovery phase. It's a time in which I ask a series of questions, some of which may seem like they have absolutely nothing to do with investing, but they really do, because they give me an idea of what is important to my client. And out of that discovery process is how we build a profile for an investor.
Thank you. And another question in the chat is, how should investors process the recent equity market manipulation by a group on the Robinhood trading platform?
Cautiously. I would say they should process that very cautiously. That was somewhat of an anomaly, and does not replace some of these key concepts that we talked about today. It was something that was interesting to watch, but I would say you want to be careful of trends like that. Many people that got in on that, they got in at the end of the activity and wound up losing money. So I would say something like that should not replace these fundamentals that we talked about today.
Are there any more questions before Tasha Garcia from Morgan Stanley wraps up? If not, thank you, Tasha, for coming out and joining us here at our BLING conference. If there are any questions that come up at a later date for Tasha, I ask that you place them in the chat and we will get those answers for you after the conference. Tasha has also put up her contact information so you can make note of it, take a quick photo of it so that you have it. And again, if you have any questions that come up for Tasha, feel free to put them in the chat and I'll make sure that she gets to them and gets an answer to us after the conference. Thank you so much, Tasha.
Thank you so much for having me. I hope everyone stays safe, and have a wonderful weekend.
Well, I know that I will after this conference.
Thanks, Raquel. Take care.
Thank you. Now we bring on our next speaker, Miss Lauren Holland. Are you here?
Yes, I am.
Yes, okay, I see you now. So we bring up Miss Lauren Holland. Lauren is someone who is from the paper and packaging sector within CreditSights. She's an experienced fundamental credit professional for over 20 years. She's going to be with her here today to tell us more about what she does for her within her position and tell us how we can benefit from her knowledge. So Lauren, I thank you for being here. Please tell us a little bit more about who you are and what you do for CreditSights.
Sure. So greetings, everyone. I'm glad to be here today. So I am, I'm a fundamental credit analyst. So a little bit different from, I didn't get to hear all of, Tasha's presentation preceding me, but from what I gathered at the end, it sounds like she's a financial advisor at Morgan Stanley. So she provides, I'm assuming that she provides, and correct me if I'm wrong, Raquel, that she provides advice to individuals via private wealth management. Morgan Stanley is actually a client of my firm. So I am an investment analyst, and my clients are primarily institutions. And specifically, I heard question at the end about the stock market or focusing on equities. I specifically focus on corporate bonds. So companies issue both debt via corporate bonds and equities, to fund themselves, to raise money to, to finance their projects. But like I said, I focus on the corporate bonds as opposed to equities. So specifically what I do is that I conduct research, looking at companies' financials, like their financial reports that they put out on a quarterly basis. And, I analyze the results and make recommendations to clients on, what I think about like the company's financial reports and how I think they should position themselves by investing in those securities, specifically, like I said, corporate bonds. And as you stated, I focus on the paper and packaging industry specifically. And as I said, I've been doing this for 20 years. I started at Lehman Brothers a long time ago. I worked at credit at Citigroup as well. And then I spent some time at a couple of investment managers. I also ran my own hedge fund for a while. And then I've been at credit sites for the last 6 years.
Can you tell us a little bit more about your entrepreneurial efforts and how they helped get you to where you are today?
My entrepreneurial efforts and how they helped me get to where I am today. That's a good question. So, well, I have a couple. I mean, I do have a couple things that I do outside of like my quote unquote day job as an investment analyst. I guess as far as my spirit of being an entrepreneur is that, as a credit analyst, I run, even though I work for a firm, at the end of the day, I'm responsible for my own franchise and how I run, my business, quote unquote business as an analyst. So, how I engage with clients, how I engage with the companies that I cover, how I produce my research, how that research, looks and feels, how I differentiate myself, from my competitors, because I do have, competitors, primarily like, for instance, Morgan Stanley has their own, institutional credit research, that they put out. And, my clients will not only read my research, but they'll also read, Morgan Stanley's research, or they'll read, research that, that like a Bank of America, produces. But, how I differentiate myself from my competitors, it does require that entrepreneurial spirit to, to continue to evolve, and, produce research that is interesting, that people, want to engage with, and also are interested in, because you have to have that edge, because there's a lot of information out there. And as, kind of alluded to with the whole kind of, the GameStop, the Reddit, the how social media has kind of taken over, with the investment process, just how people, like I said, engage with information that they use to make decisions. You really do have to be kind of ahead of the curve, and even getting new sources of information, right? You have to kind of incorporate that into your research, because it does go far and beyond just reading, quarterly financial statements to understand, just how companies are performing, and what impacts their performance.
Well, what kind of work did you do that prepared you to be a credit analyst?
Well, I mean, the direct preparation. So prior to me going to business school, I got my Booth, my MBA from Chicago Booth. So that was sort of like, I guess sort of like the transition that led me to Wall Street. But prior to that, I was an engineer, a chemical engineer. I got my undergraduate degree from the University of Oklahoma. But, I guess that is really sort of, what prepared me to work in this business. But it was really more so, just a choice where I decided that, I wanted to leave engineering and, to come to work on Wall Street. So it was, going to business school, preparing for this, to come into this industry, the whole interview process, networking, heavily networking, meeting people in the business, in the industry, learning the industry. But I really say outside of actually going to business school, the networking was probably the biggest part of the preparation process.
Now, we asked it earlier from one of our guests that we had about the importance of investing in oneself,
Yes.
from the perspective of you went to college, like she went to college, with one thing in mind, but came out doing something else.
Mm-hmm.
Do you have any regrets doing that? What was that journey like for those of us who are listening about investing in yourself and taking that risk to switch up and
Mm-hmm.
pivot and do
Mm-hmm.
something else?
No regrets whatsoever. So I actually knew pretty early on that I wasn't going to stick in engineering long term. I literally got my degree and worked in industry for 3 years, which was the minimum amount of time I needed to work before I went back to business school. I think I didn't know, I wasn't sure that I was going to wind up on Wall Street until I was probably about 2.5 years into my engineering career. That's where I was going to wind up. I just knew that I wasn't going to be an engineer because I was, like I said, I was a chemical engineer. So I literally worked at in production plants. I worked at plants. I was living in Louisiana and South Carolina and in Tennessee. So I knew I wasn't going to do that long term, but I thought that I was going to get my MBA and then I was going to stay in the industry and work over, basically transition over to the business side of the industry. So still work for a chemical company, but then do marketing and finance as opposed to actually working in production. I was, like I said, 2.5 years into my engineering career when I was working with someone whose brother was at Wharton as an undergrad. And he was, aspired to work on Wall Street. So we started having these conversations and I was like, yeah, I always had this interest in financial markets, but never really thought about it like that. And he was the one that kind of no, go to business school. You should go to University of Chicago and then you can go and work on Wall Street after that. So he kind of put this thought in my head. And then after I explored it, and like I said, again, it's all networking, learning more about the business, networking, reading, I was like, you know what, this is something I'm going to do. And as you said, making that investment in myself and taking that risk, it's funny because when I told my father that I was quitting my job to go to business school, my father's like, you're going to leave that job? Those people gave you that job. That's a good job. How you going to quit that job? And but this is what I did. And trust me, it absolutely paid off. And, I'm celebrating my 20th, my 20th year class reunion from business school this year. And, I don't regret it at all.
That was you talked somewhat about what I was going to ask you next about moving to Wall Street. Why was it so attractive? And what were some of the things that was exciting and challenging going into an environment that I know is a minority, it's a non-majority, it's a majority type of environment with very few minorities.
Let's be clear. I have been in a non-minority environment, since the time I got to high school, right? So this was not uncommon for me. I went to an all-girls, 95% white high school. I was an engineering major at a PWI, where in my chemical engineering class, there were two Black people out of our class of, I think it was 200 something people in our graduating in our chemie class. When I worked at the plant, I worked in plants where there was no women's bathroom in my operating unit. So like, so you know that scene in Hidden Figures, how she used to have to run? That was me. I literally had to go to the administration building to go to the bathroom because there were no women's bathrooms in the operating unit. So this whole kind of sense of being the only, that that was commonplace for me. Not at all, not at all a foreign concept. So, when I decided that I want to go to Wall Street, it was just like, just kind of like just the next natural step for me. And what the real impetus was, and I want, like, the young people that are listening here, like, please, if you take nothing away from this, you have to be celebrated and not tolerated, right? Like, I was working, that last job that I was working as an engineer, and this was pretty much my last straw. I was in a tech service position. So literally it was like my job to answer incoming calls from customers and troubleshoot their problems. So that was half my job. Half the day I spent on the phone, literally just kind of like answering the phone, troubleshooting problems, and half the time I spent in the lab where I'd have to actually run experiments and stuff like that. So I was basically like so good at my job that my volume, as far as like how I was processing, calls, claims, running experiments or whatever, they like my manager didn't believe that I was getting as much work done as I was, right? So one week they literally decided to sit somebody in my office with me to observe my calls. To listen, just to basically, because I don't know if they felt that I was hiding tickets, or I don't know what the heck they thought I was doing, right? So, it made me like so angry that I got like physically ill, right? Like I broke out in hives because I got so mad. And it was that in that week I decided I got to get out of here. Like I had to move on. And that's when I had made like a definitive decision that as much for like how much I'm getting paid to do this and have to suffer through this nonsense, like I know that for my my capacity, my brain power, like I need to take my talents elsewhere. And on Wall Street, I know I can get paid a lot more, for my time and energy. So like when I graduated, my 2 years of business school, on the other side of that, immediately I made 3 times upon graduation what I was making prior as an engineer.
Wow.
Yeah. So
I can't imagine what you went through. What was your self-care routine, or did you have one?
At that point in time, not much. Self-care is something I really just discovered like during COVID, like in the last year. But yeah, I mean not much of one, but I'm working on it. I'll just say that about self-care. I'm getting there.
Okay, well, after something like that, I can only imagine what that was like to deal with that. Have you encountered anything similar or as bad on the other side of that engineering career that you had?
You mean my time as an analyst?
Yes.
I mean, like things happen, like because it just kind of is what it is, right? Like, the challenges that we as African Americans kind of face in this business, particularly in my seat, which is a quote unquote client facing role, is this is where we're underrepresented, right? And they say like oh, I don't know if she's client friendly, or if the clients should be well received by clients. I've gotten fits and there have been fits and starts with that in some places along my career, but you just kind of push through it and deal with it. But that tends to be the issues that people of color, particularly African Americans, have to deal with on Wall Street. But I will say that the climate is changing, and there definitely seems to be a lot more focus on trying to improve this in light of what the incidents that happened in 2020. But it's still a work in progress. It's still a TBD.
Right. And just to elaborate a little bit more about that, what do you see happening specifically in your industry that looks at how to improve diversity and be more inclusive?
What do I see happening? So, all of the banks, because, as I run an organization called Wall Street Friends. That is a network of finance professionals. And I invite everyone to put in the chat here to visit our website. And, there's a page, there's a tab on the page that says join the network. So click that and scroll down, fill out the form. You can join our mailing list. There's also a job board on there where we have job postings. But, I literally have had, at this point, I think we probably had conversations with over 50 different financial services institutions. We've engaged 2 as partners at this point, and I'm in active conversations right now with at least a dozen more. I've actually lost count. But, there is work definitely being done because a lot of these banks realize that they have serious problems, even though, D&I is not something new for the street. Banks are realizing that what they have been doing, or they think they've been doing for the last 20 years, and on a lot of levels is not working. Because the street hasn't had an issue as far as attracting Black talent. It's just a matter of promoting and retaining Black talent. So banks that are actually getting it right are actually putting measures in place to actually kind of fix that. And it really doesn't come from your CEO saying oh, we have a problem, or oh, we're committed to diversity. You actually have to have policies and procedures in place, particularly in the mid-level, to combat the friction that middle managers face that prevent them from being actually promoted. So we're just in the very, very, very early stages of this, and there's a lot more to be done, a lot more work to be done, but it's definitely still a work in progress.
Is there anything that you can say that where you've helped move that needle for diversity and inclusion in your field?
Yeah, I've been like I said, just running Wall Street Friends. I've been, this organization's been around for 30 years. I've been in a leadership role for the last 8. I actively mentor professionals, and have been my entire career.
I'm sorry, can you tell us the name of that organization again?
Wall Street Friends.
Wall Street Friends.
Yeah. Yeah, I put the website
in the chat.
Yeah.
Okay, well, I want to thank you for being here, and I want to continue to encourage people to put their questions and comments in the chat. I know that they have been coming through. I wanted to ask you about credit sites. You've been there for a certain number of years, and I wanted to know, how could someone who is interested in your field, how do they network into that field? You talked about networking that got you into grad school, and how it has furthered your ability to be successful in your field. But how can some of our students find their way into your field? In addition to you,
that's a great question. That's a great question. So right now, we literally, look, I'm trying to hire a junior analyst right now. My current junior analyst, her last day is today. She needs to be replaced. So I'm looking for an entry-level junior analyst, right now. So if you're a, business major, finance major, econ major, and you're interested in finance, you're interested in working on Wall Street, you can find me on LinkedIn. So reach out. The job hasn't even actually been posted yet. But definitely reach out to me on LinkedIn. Because like I said, I need to hire yesterday.
What are some basic requirements? Do they need to have finished their degree or be graduating in June? What's going?
Already finished. With no more than 2 years of graduate experience, or between no more than 2 years experience, or finishing in June.
Okay.
It's an immediate need.
So this is for something for our graduating seniors.
Yes, or somebody that's graduated
Or
within the
what?
last 2 years.
Okay,
No
okay,
no more than 2 years experience, because like I said, it's a quote unquote entry level role.
got it. Because we can get you some people. We can get you a couple of names.
Yeah, we actually, I mean, really, the firm is actually, we're actually looking to hire 4 to 6 juniors right now.
Okay,
Yeah.
okay. Yes, we can get you some names for that, because we do have students who are in our finance and business majors who might be interested
Send them my way.
in such, who are graduating that might be interested in such a position like that.
Yeah, send them my way. Send them my way, because the thing about credit research specifically is, like, everybody knows about equities, but people don't focus on credit as much, on this part of the capital structure. But it tends to be a little bit more for people that tend to be a little bit more quantitatively inclined. Again, like I said, I was an engineering major, but the truth of the matter is, like, we got somebody like that works with me, works on my team, that was a journalism major. So, I think it's more so having a passion for the markets and really wanting to do the job, more so than like the skill set. Because a lot of this, even at the big banks, people in analyst programs at the big banks have all kinds of backgrounds. They're not all finance and business majors. It's just like, I mean, I know this is being recorded, but I'm gonna tell the truth. The bar tends to be higher for us than
Right,
the others.
right.
They tend to want the perfect resumes from us than opposed to the others. You know what I mean? So,
Well, we have a couple of questions, a raised hand rather. Ayana, you have a question.
Hi. I just wanted to ask, on that note, from what she just said, so how would you advise somebody to pivot into the finance field if their background is not finance or anything along that line? So if you're coming from something else and you don't have a master's in finance, you have a degree, but you want to then, get into finance or something else, what would you advise?
It's really about exhibiting the passion for the market and the role, and showing that literally demonstrating that you can do the work, right? Because, so the interview process tends to be pretty standard. You'll have some rounds of interviews where you meet people from the firm, and then you actually have to, show that you can actually do the work. So you have to analyze a credit. So we'll give you, some financial statements. You'll have to actually, spread some numbers, build a model, or, we'll actually have you, write up like a kind of a mock earnings report, right? But how do you learn how to do that? There are a plethora in the year of our Lord 2021, there are a plethora of resources out there, on the internet, Al Gore's internet, that can show you how to do this. Wall Street Prep, Khan Academy, Wall Street Oasis. There are a bunch of them out there. I mean, you could Google Wall Street interviewing. Like, they'll show you how to do a stock pitch. They'll show you how to do to write up earnings reports. Like, you can literally learn how to do all this stuff. And, shy of actually having to go on Coursera and try to do like an internet, do online MBA or something like that. Like, you don't even have to go through all that. But if you can actually just demonstrate that you know how to do the base level work of how to analyze a credit or how to analyze a stock, and to get you through the interview process, but like I said, but also exhibit that you have like the passion, like that actual passion for the markets. I mean, that's really it.
We have some more questions coming in, some more raised hands. Dr. Zarbabal and then Dr. Price.
Hey, Rob, yeah, okay.
Dr. Zarbabal, go ahead.
So my question that I asked, you actually just answered. I'm a faculty in finance at MEC, and you basically just explained all the hard skills that they need to know, and you even gave the websites on where to get those hard skills. So that was awesome. So let me use my opportunity to ask a different question about fit, because it used to be on Wall Street, the entry-level interviews were a lot about fit. Can you talk about fit and being your true self in that setting?
Yeah, I mean, that's the squishy part, right? Fit.
I know, right? A lot of our students, we're not familiar with that space. And when we enter it, it seems very foreign, sometimes intimidating.
Man, all I can tell you is, you know, it's like, it's cultural. It's culture. Like, you know, how do you learn fit? Without having sort of grown up in the business, you just kind of have to learn how to speak the language. So like, I guess, how did I learn fit? I guess I read Liar's Poker. I read Predator's Ball. You know, I watched the movie Wall Street. But again, like, this is all old school stuff, right? Like, you know, that sort of, like, you know, kind of culture is really kind of frowned upon now. Like, you know, even you know, just in the last couple of days, like, this survey has come out of Goldman Sachs that the investment banking analyst responded to, basically, you know, bashing, like, you know, like, their work-life balance and how horrible it is to work at Goldman Sachs. Now, the interesting part is that I think Goldman probably has, I'm sure they have at least probably 300 to 400 investment banking analysts, and only 13 of them actually responded to the survey. But nonetheless, like, the survey's terrible. Like, it's absolutely horrible, but it's not anything that people working on the street don't already know. And, like, you know, nothing's changed, like, in the last, like, you know, forever, like, as far as, like, what, you know, what the culture is like. So, but again, like, what you were calling fit is really like, it is an extension of the environment that you would, you know, of you know, Ivy League schools. Like,
Exactly.
because again, this is where all these people come from, right? So you just kind of have to learn that, you know, that type of culture. And like, and I say, you could glean a lot of that from the books, the movies, like, watch Industry on HBO. It's like on HBO Max. I think that's a great series. I think they did a really good job as far as, like, accurately depicting, like, what you know, what the life is like for investment banking analysts or whatever. But yeah, but I don't know. I feel like a lot of that. I don't know. I feel like I said, a lot of that they're trying to wash away, but at the same time, like, it, you know, this is what I was saying about with the whole D&I thing, as far as inclusion, how the friction is in the middle, because you still have people in these roles that still uphold that type of culture, but at the same time, to breed inclusion, you kind of have to wipe that away. You know what I mean? But
exactly,
Thank
the socialization of it.
But at the same, but then at the same time, there's still like a minimum level of professionalism that has to be adhered to. Like, you still don't want, like, you know, you're still not gonna show up at an interview, you know, like, with a purple suit on, right? Like, you understand what I'm saying? Like, yeah. So there's a fine line there.
Thank you. That's great.
Thank you, Dr. Price and Dr. Rowe.
Yes. Well, first of all, Lauren, thanks for taking a last minute call. I know you're very busy, so I appreciate you.
No problem.
And secondly, what are some of the common mistakes African Americans make in these type of environments?
Oh, that's a good question. Common mistakes African Americans make in these type of environments. I'm trying to think, like, where I've seen people blow themselves up. Not networking internally at the firm. Not networking externally. So like leveraging Wall Street friends, for instance. Like, you gotta, you know, you gotta basically have friends elsewhere. So when that time comes, you're looking for the next opportunity, you know, you want to basically have, you know, eyes and ears everywhere. But like I said, like, not networking internally internally is a big one, because you gotta have, you know, your champions in your reporting line, but you also got to have people outside of your reporting line that can speak to what it is to speak to whatever your contributions are. Because people will think like, oh, I just keep my head down, I do my job, I'm great at my job, and that's good enough. Like, when it comes time for, you know, quarter end, year end, whatever, as far as when it's time for that promotion or whatever, that's not enough. You got to have people that can actually be your champion and can speak intelligently to what your contributions are. And somebody's got to be able to go to bat for you, because it's not necessarily bad if somebody says something bad about you. The bad thing is if somebody says nothing about you. You know, so you got to want to have those champions. But you know, I think my time here is done. And I actually have like another appointment that I have to hop to. So I really appreciate the opportunity, you know, to share with everyone. So like I said, you can find me on LinkedIn. Definitely.
Lauren, I'm sorry, can you take just one last question from Dean Roll?
Sure. Sure.
Lauren, this has been wonderful. Thank you for taking the time. All morning long, we've heard about the network. How can these students start building stronger networks? They're not at Harvard, they're not at Yale, they're not at Wall Street yet. How can we help them to start building those stronger networks that's going to yield a career where they want to go, wherever that is?
Join Wall Street Friends.
We'll make sure that we get that out there.
We have 30 years worth of, you know, finance professionals on the street. We're 8,000 deep. Join Wall Street Friends. You know, we've been doing events in person in the city. Like I said, for literally like the last 30 years, but we've been virtual, obviously because of COVID. But you know, we have professionals in this network that are willing, you know, to support students that are interested in being in the business. And our sole goal is to, you know, is just to have people, you know, to grow the amount of people that are in the business. So as like I say, join Wall Street Friends.
Thank you, Lauren.
Yes, thank you. Bye, everybody.
Bye, Lauren. Thank you again for that. Thank you, everyone, for being here. We have another speaker that is coming up at 2 p.m. That is going to be Stephanie Mason, who is the Assistant Professor of Accounting at DePaul University and Vice Chair of Black Alliance of Colleges and Employers. She's going to be talking about building intergenerational wealth. Stephanie, are you here?
I am here, and I'm just so excited to follow Lauren, who actually was behind me as a graduate student at Chicago.
Oh, wow.
Yes.
Wow. Well, I want to thank you for being here, and we are going to go right into your session. Yep. Even it's 60 seconds early, but can you just tell us a little bit about yourself? Yep. and about your topic?
Yep. So I'm Stephanie Mason. I am on the faculty at DePaul University. Have been there for 6 years. I started my life as an undergraduate accounting major at North Carolina A&T, and I moved to New York in the 90s to work at Deloitte. Worked there, and then went to the University of Chicago and got an MBA in finance and accounting, and spent 12 years at JP Morgan in the private bank and at JP Morgan Investment Management. So this is a topic that that I'm really passionate about. When I was a PhD student, one of the things that Rutgers required was a class in the business school for undergraduate students about financial awareness, and I've participated with the American Institute of Certified Public Accountants Feed the Pig campaign. This is like my passion, so I'm excited to talk about it, and I have a few slides if you can give me the ability to share, but I certainly would like to have an open dialogue.
Go right ahead, you can share.
Okay. So the first thing that I want to kind of frame is the important word I think here is intergenerational, right? So this is the thing that ties us to our families. So as I was working on this last week, I thought a lot about my mother as the architect of some of this. When you are in that sandwich generation where you are having to think about planning that involves both your parents and your children, right? And the one thing that I will say, as one of my closest friends just texted me and I told her what I was doing, and her response was, I have to start talking to my daughter more about these kinds of things. This is something that we have to, from a community standpoint, do much earlier. And so the 3 words that I always want people to take away from thinking about this is, why is it important? 1, it provides clarity, right? I'll talk about each of these in a second. It provides efficiency and some resiliency. I've been talking a lot about this. I'm almost 50 and my mother is 75, and transition is something that, we talk about, and really starting to get a sense of what's important. How do you want to spend your time, your goals, your children's goals, your parents' goals? How do you achieve a lifestyle? I want to tell a little bit about my story because I think it's important here. I bought my first house in Brooklyn in Fort Greene in 1998, when I had been working at JP Morgan for a year. And it was the single best thing that I ever did. But in the years that after I bought there were dramatic changes to Fort Greene, as like in many of our neighborhoods in New York, because I still partly live here. And one of the risk of what is happening in this era of what I will call push out, that some people call gentrification, is that we are often very quick to sell our homes, which is the traditional anchor for intergenerational wealth transfer in this country, right? So when we measure in a private bank or in any kind of financial institution a person's net worth, one of the first things that is going to be thought about in the calculation is, what home do they own? And so when I talk to young people, particularly my students, they say, oh, I can't afford to buy a home. And I say, well, you already have bought a home. You've just bought someone else's home, right? And so getting clarity of why you're coming into work every day and what those resources can do for you, knowing your goals, how you want to live, and what you want to achieve, I think is central to this notion of intergenerational wealth and efficiency. Often we don't start doing something because we don't have clear strategies, but there are 4 questions that I would always pose when I would, encounter clients. What do you want to invest in? You don't have to necessarily know about investing to have an idea of what you might want to invest in. Questions like, should I invest or should I pay down my mortgage? These are real questions that may lead to freeing up money for, the future. How can I reduce my tax bill? The beginning of my career at Deloitte was in tax, and it's something that I think about. And then for most of us in this world, how do we effectively, and that's an important word. It's not just passing wealth to your children. And yes, we should think about this even when we're in college, right? Because it may make some choices in our life different. But we also have to be resilient because we are the community that often bears the worst brunt of every crisis that America has to offer. And so being prepared for the worst helps us have some peace of mind that we can withstand these crises. So just really quickly, and I'll be happy to share the slides. I always say that wealth management, which leads to intergenerational transfer of wealth, is segmented into 6 pillars, but you gotta have the first part, right? You don't get to number 6, estate planning, unless you first successfully managed your cash, right? So that becomes an essential piece that I'm gonna talk about. Pay yourself first is what I always tell my students. I will have students who will say things like, but it's not a lot of money. Well, it's more than you had. All right, so budget, force yourself to save and manage your debt. Remember that interest, this is a definition that my grandfather taught me when I was 10. Interest is the rent you pay for the use of someone else's money, right? So if you are thinking about, should I borrow to get this textbook, or should I borrow to get these new sneakers? You got to think about where the return on the interest that you're paying is going to come. And it's probably going to be more so on the textbook than it is on the sneakers. The family trust and planning, this is something as you start to accumulate that I won't go into because I'll share the slides. But keeping in mind that it's never too early to think about planning for the next generation and putting your assets in trust, especially for those of you who may be budding entrepreneurs and who have startup ventures. Along with that comes business succession planning, because often when I think about Brooklyn in, let's say, the 70s, when I used to come visit my grandfather's sister, there were thriving Black businesses in Brooklyn that often are not existent today, primarily because the next generation moved on, they moved to different places, and there wasn't a plan. And we have to be really good and intentional about keeping our businesses in our community generationally. Retirement. This is something young people cannot afford to ignore, even when they are just starting their careers. Along with that is tax planning. I say always, you got to max out on your 401k from the beginning. Students say, but I can't afford to do it. You can't afford not to do it, is always my response. That is one of the central tools, I think, of being able to reduce your tax hit, but also to build in a way that will put some resources aside that you might be able to borrow against in the future when it's time to buy a house or at transition time. So before I start taking some questions, I really wanted to go to this how do I start slide, which I always use with my students. And this often, I would say, involves really hard family conversations, right? Because sometimes in our community, we have a really difficult time talking about money with our parents or with our children. And so what I always suggest is have a family governance meeting, right? Your family is to be treated just like, some of these other ideas. And if you want to think about managing wealth, a family governance meeting, sometimes difficult, may be an avenue to start the conversations. Long-term strategies, what charitable endeavors are you interested in? And it's important to involve the entire family, including kids. Life transitions provide opportunities then to revisit your plan. So I'm from a big Southern family and with lots of cousins. And when we get together over holidays, pre-pandemic and hopefully post, when there are transitions, in terms of someone's graduated, had a baby, reached a new milestone, I try and use that in my family as an opportunity to say, okay, what is the plan looking like now? And how can we update this plan so that it is current? Because what you want to have is a roadmap to follow in case there's some unforeseen event. Now, I say this because I have lots of godchildren. And one of the things that I try and do is to give them gradual gifts to evaluate how they handle money. Because I've been having this long-standing argument with one of my closest friends who gives her daughter a lot of resources without thought to whether or not she's capable of managing it. And then she gets upset, for example, when she has to then provide extra resources because she hasn't managed it well. So I'm an advocate of giving children, even smaller children, gifts as they move to try and see how they will manage it. Because if they start managing money early, they become better stewards of managing their money over a lifetime. And I always, attribute my grandfather getting me my first checking account. He used to make me keep that check ledger. And it helped me think about where the very few dollars that I had as a young person was going. And another thing that kind of involves the other side of the coin is to discuss end-of-life care with parents and children. And I know this is a really tough discussion to have, but it's necessary in terms of thinking about, where your dollars are going, and also to be prepared to not be caught unaware in the event that something happens. But one thing that I put in bold, the last thing, is involve professionals, but check their credentials. Let me repeat that. Involve professionals, but check their credentials. So I sit on the AICPA National Accreditation Commission, and that commission is responsible for all of the accreditations that the AICPA does outside of the CPA exam. And one of those credentials is the certified in, it is somewhat like the CFP. So there are two major credentials. One is the CFP, which is the Certified Financial Planner, and then the PFS, which comes from the AICPA. Don't be afraid to check people's credentials out, because the last thing that you want, I was just reading a story that's about to be litigated in New York, where Kevin Hart, the comedian, is embroiled in a lawsuit where someone literally spent $1 million of his money as a quote unquote personal shopper, but he never really checked the person's credentials out. And in this environment, the online environment, it is so easy to check people's credentials out, because the last thing you want to have done is to put all of this stuff aside to transfer to the next generation in your family, only to find that it's been spent by someone else for their family. So I will stop there, because I really think it's more important to have a dialogue with people about their goals. So I will start taking questions now, and we'll take them until the end of my time.
Thank you for that. That was marvelous. So we do have some questions. They came up in our chat box. But one question while I get to that is, what kind of budget can we give young children to follow so that they can learn how to manage their money?
Yeah, so one of the things, I'll start using an illustration that I've been working on with my goddaughter. Because when I first moved to Chicago, she and her mother lived in my house, and the allowance that I gave her, which was $100 a month, she needed to give me a budget for it. And one of the things that she needed to do was include in her budget how she planned to tithe, right? And while that may not be something that everyone does, she had $100, 10% of that needed to go to church. And so then she needed to write up how she planned to spend the other $90, right? And I think some of how a child budgets has to do with where do they go to school? Are they eating lunch at school? But it has to, in my opinion, be collaborative, because I think where children have agency in a process, they're much more likely to stick to it than for us to say, well, this is what you're going to spend it on. because they will spend what we give them on what they want without our sanctioning or not. And I think sitting down with them and a piece of paper to say, you need to, let's write out what you're going to do with this allowance that you have, whether it's $10 or what, helps get their buy-in, if that makes sense, Raquel.
Yeah, no, it does. It does. There was a question in the chat, talked about the, getting back your best investment for what you're paying.
Yeah.
And there was, comment, paying rent to someone is paying to take care of someone else's property. Well, we're in a recession for many of us. How do we find a way to purchase property and be more profitable when it comes to our housing during a recession?
So one of the things that I am an advocate of, and this is very specific to Brooklyn, although I expect this may also apply in other parts of the city. There are parts of Brooklyn where they need our investment, right? Where our investment would be welcome. And so my cousin and I, for example, we partnered very early in identifying real estate opportunities that we could collectively go into, because it may not always be possible to do it on your own. That's the first thing. The second thing is New York State has a program through Sony Mae, which is the state equivalent of Fannie Mae, that allows you to borrow the cost. And if you buy a fixer-upper, there are additional dollars that would be available to you. It used to be downtown Brooklyn, but now that Junior's has slightly moved for building of another apartment tower that we probably don't need, there used to be a service centered downtown Brooklyn called Neighborhood Housing Services. So I remember that when I bought my first house, I went to NHS because the kind of loan, I think it was called the 203K loan program that I had to buy a fixer-up. And I went to landlord training there so I could learn about how to be a landlord, so that I didn't make some of the missteps that I knew other people. So finding people that you can partner with, that you trust, I think is a viable way to tackle the real estate market. And you don't always have to tackle the real estate market the first time for the place that's going to become your primary residence. You might buy the first time in cooperation with someone else and be a landlord before you become a homeowner for a place that you actually live, right? Mm-hmm. And so one of the things that I think we have to think about is what is projected to be the next neighborhood to pop, not the next neighborhood, the next. So 10 years ago, people who got into Red Hook are paying the benefits, or reaping the benefits today, right? So I got into Fort Greene in 1998 and held, right? And so getting into Fort Greene in 1998 gave me the ability to, quite frankly, I always joke, I'm sure Shannon is on this call, who is also at DePaul, but I always say, if those folks at DePaul get on my nerves too bad and maybe choose not to tenure me, the biggest investment in me was buying a house in Brooklyn, so I can always come home and live, right? So doing those kinds of partnering with people and the house does not have to be, when you buy it, a mansion on the inside. Sometimes you just got to have a little bit of vision about what it can be, so that you don't walk away from an opportunity to stick some wealth aside.
Can you tell us a little bit more about living trust and their benefits?
Yeah. So one of the things that, especially for people who are starting businesses where there may be a high litigation risk, for example, shielding some of your assets from, I would say, being tackled by what the litigious society in the U.S. Could cause, I would say, fallout from that. Putting your assets in a living trust helps in some respects shield your assets from the negative environment that could come. The ladies who are behind me, I think this is the kind of stuff they really do. When I was at Morgan, a lot of the trusts that I worked with were things like charitable lead and charitable remainder trust. So for people who have real charitable goals that they want to make sure get carried out in their lifetime or after, that's also something that you should think about. If you are a philanthropist in the making, I think that is a good, but the trust world is huge. There are iterations of trust for every single thing that you can think of. And that's in particular where I think someone should use a professional, because the last thing that you want, if you do, whether it's a charitable lead, charitable remainder, a living trust or whatever, is to have the best current advice on that, so that you don't find yourself in a situation where either your tax paperwork has not been appropriately filed or your trust documents.
Right. I know you talked about the getting family involved in this process and having a family conference. How, what are some strategies to get to that point when you have parents who are not encouraged or feel that it's too soon to talk about these things? How do you get parents and children often into these discussions to have that kind of dialogue about wealth and end of life and everything?
I'm going to say this from my perspective, because I'm the hesitant one in my family. Okay. As much as I can talk about the money aspect, and so I'm an only child, and both my parents were only children. And so my father passed away 12 years ago. And I would say over the last like 4 or 5 years, every time I go to South Carolina, my mother wants to have the conversation. And she wants to pull me over. Let's sit around the table and let's talk about all these things. And I find myself being very resistant to those conversations. So what I am saying comes from a place of, I certainly know what it's like to be resistant. What I generally say is the best way to start the conversation is not with the hard stuff, right? See, my mama wants to go straight to the hardest stuff to talk about and then work her way backwards. I think, though, that the way to introduce the conversation is with something that's not so difficult to talk about. And one of those things is around charitable giving. We are the most charitable people on the planet, period, right? We give beyond what other communities do. And I think that's always a good way to start. We don't always think about it as charitable giving. So how we organize our conversations can start around that. We give, thousands of dollars, tens of thousands, millions to our educational institutions and to our religious institutions. So starting there as a part of the conversation, how do we harness that into being more targeted? How do we harness that into being bigger participants? One thing that I say to young people, always give to your alma mater, right? And people will say things like, oh, but they didn't, your alma mater gave you the ability to, to soar. That should be a part of your planned giving, the ability to impact the young people who come behind you. I can't say enough that, especially if your parents have sacrificed, for example, to send you to college, let's think about how do we set some small tools aside that people behind us can benefit from. If it's a book scholarship at your alma mater, that becomes a wealth planning tool, because today's book scholarship may end up